Well, if you checked on your silver holdings on the very last day of the year, I'm sure your stomach dropped a little. Seeing that much red on the screen, it's jarring. After a long year of holding on, a day like that can feel like a real kick in the gut. It's enough to make anyone second-guess things.
And it absolutely felt like someone just pulled the rug right out from under the market, didn't it? But here's what I want to walk you through today. What you just saw, that wasn't about the real value of silver. It wasn't some sign that you made a bad choice. It was, believe it or not, a predictable event driven by behind-the-scenes financial machinery.
I mean, let's be honest. An 8% drop in one day is a huge move. It's the kind of thing that gets your attention, and not in a good way. It wiped out recent gains, and frankly, left a lot of folks feeling completely bewildered. And that huge, sudden drop is exactly why we need to pull back the curtain and see what's really going on.
And that's the big question, right? All the reasons you own silver, the out-of-control government debt, the constant money printing, the massive and growing industrial demand, none of that went away overnight. So why the big crash? Well, the answer has almost nothing to do with silver and everything to do with some strange banking rules that only matter on one single day of the year, December 31st.
So here's our game plan. We're going to tackle that shocking drop head on. Then we'll dig into this banker's accounting day to see what forced their hand. We'll look at the huge difference between the price on your screen and the physical reality. After that, we'll talk about something called the January effect and why a rebound is likely. And finally, we'll put together a clear plan so you can feel confident moving forward.
All right, let's start with what some people are calling the New Year's Eve massacre. It's a dramatic name for sure, but it felt that way. The key thing to remember is that this was a temporary liquidity event. It was a manufactured dip, not a fundamental one. You could almost think of it as one last big shakeout to scare people before the new year truly begins.
Now, this is the most important part to understand. The flood of selling, it wasn't coming from regular folks like you and me. Nope. This was driven by some of the world's biggest banks. And for them, December 31st isn't just another trading day. It's their annual accounting day. It's picture day for their balance sheets.
So here's how this little game works. On that one day, regulators take a snapshot of the bank's books to figure out their systemic risk score. Now, holding assets like silver actually makes that risk score go up. And if their score is too high, they have to lock away billions of dollars in extra cash reserves, money they can't use. So what's the easy fix? Right before the snapshot, they dump assets and load up on cash to make their books look as safe as possible. It's all for show, but on a quiet holiday trading day, that forced selling has a massive, dramatic effect on the price.
And, as if that wasn't enough, there's a second punch. Hedge funds use the very same day for what's called tax loss harvesting. Basically, they sell off some of their losing positions to create a paper loss, which then lowers their tax bill on their winning investments. So you've got two different groups of huge players selling for reasons that have nothing to do with the actual value of silver.
But here's the kicker. All of this, it only really affects the paper price that you see on your computer screen. And this is where the story gets really interesting. Because there's a world of difference between that paper number and what's actually happening with real, physical silver you can hold in your hand.
This chart just says it all. While the paper price was taking a nosedive, if you actually tried to buy a physical silver eagle, you would have seen something incredible. Dealers weren't lowering their prices. In many cases, they were actually raising their premiums. Now, why on earth would they do that? Because they know this is a fake, temporary price. They know they can't go out and replace their inventory for that cheap, so they simply refuse to sell at these artificial lows. That right there tells you the physical market is strong. And it's not just the coin dealers. Think about the huge industrial users, companies that need silver for everything from electronics to solar panels. When they see a sudden drop like this, they don't see a disaster, they see a sale. They step in and start buying in huge quantities. This real-world demand creates a solid floor under the price, soaking up all that paper selling.
So we've seen how the calendar, this weird December 31st deadline, created the crash. Now let's flip the script and see how the calendar is perfectly set up to create a powerful rebound. It's a well-known phenomenon called the January effect.
The best way to think about it is like a slingshot. On December 31st, all that forced selling pulled the rubber band way, way back. Then on New Year's Day, the markets are closed, but that tension is still there. Then on January 2nd, whoosh, a giant wall of new money from pensions, 401ks, and other big funds floods into the market for the new year. And what does all that new money find? A market where all the forced sellers have vanished. That can cause the price to snap back, sometimes just as fast as it fell.
You know, if you're finding this breakdown helpful, we'd sure appreciate it if you'd like, share, and subscribe. It just helps us continue to get these explainers out to folks who need them, especially when the markets get a little chaotic.
All right, so we've covered the what and the why. Now let's talk about the most important part, what this all means for you. Because understanding the mechanics is one thing, but keeping your confidence and staying focused on your plan, well, that's everything. So let's just boil it down to the key takeaways. First, and this is the most important one, you haven't lost a thing unless you sell. You still own the same number of ounces today as you did yesterday. Second, remember that all the real reasons for owning silver are still firmly in place. Third, this was a mechanical event, not a fundamental one. It was about accounting, not value. Fourth, the physical market proved its strength. And finally, history has shown us that after these artificial smackdowns, a sharp V-shaped recovery is very common.
There's an old saying, and it's one of my favorites. The market is a device for transferring money from the impatient to the patient. A day like New Year's Eve, that was a major test of patience. These kinds of events are almost designed to shake people loose from their convictions right before the market turns. By understanding what just happened, you can make sure you stay on the patient side of that wealth transfer.
And so I'll leave you with this final thought to carry into the new year. The price on the screen absolutely dropped. That's a fact. But did the value of an ounce of silver actually change? Did its thousands of years of history as real money, its scarcity, its essential role in modern technology, did any of that change from one day to the next? I think you know the answer.